Okay, good afternoon and welcome back. Welcome everyone to our options education session this afternoon. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we have a very action-packed session for you to teach you how to generate more consistent income utilizing options. Not only are we going to talk about best practices of trading option strategies, we're really going to focus on why certain strategies allow you to build confidence and the different best practices that you need in order to utilize these strategies to gain more consistency in your trading. So first of all, I want to thank everyone for taking the time out here this afternoon. Whether you are a first-time viewer here at OptionsPlay or you are currently a member of ours, welcome back for those of you that are current members, and for those of you that are first-time users of OptionsPlay, hopefully you learned something regarding how options trading can be beneficial for your portfolio and then how to access everything that we have to show you here today. But today, as far as trading goes, my primary purpose today is to help investors gain some consistency with your trading, with the type of strategies we're going to discuss here today, and making sure that you have access to the tools, the education, and the research for you to implement these strategies after you learn them during our today's session. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, there is a chat window at the bottom of your screen, and there's a Q&A window at the bottom of your screen. For now, during the session, you can bring up your chat window. We'll ask you some questions during the session. Feel free to type in your responses during that session. It allows me to understand, the audience and making sure that everyone understands before I move on from one section to the other. So what we're going to discover here today is we're going to talk primarily about one trading strategy. And this one trading strategy is very important, especially whether you're an experienced options investor or you're brand new to options trading. Credit spreads is a strategy that I recommend for all options investors. And we're going to talk about why, because it's a very forgiving strategy. And it's a strategy that really allows investors to build confidence. And I think regardless of whether you're experienced or a new trader, building confidence is something that can really go a long way in helping you continuing your options education and utilizing options for your portfolio. So we're going to discuss what a credit spread is. Then we're going to go through a bullish example of this particular trade. We can also look at bearish examples, but we don't have quite enough time to go through both. We're just going to go through bullish examples here today. Then we're going to talk about the optimal credit spread. What exactly do you look for? When do you trade a credit spread? What expiration date? What strike price? We're going to show you our back tested results so that you can see what are the optimal settings. And then we're going to show you how to find an options edge, because not all credit spreads are the same. You want to find credit spreads that give you an edge. So we're first going to define what that edge is. Then we're going to show you how to find it. And then we're going to show you how to access our real-time credit spread signals. This is our report that actually finds credit spreads with an edge for you in real time and gives you a report so that you can trade these types of strategies that you're going to learn here today. Then we're going to talk about the 4 rules for trading credit spreads, for managing credit spreads, for entering credit spreads. These are the rules that you need to stick to if you want to gain consistency with your trading. And lastly, we're going to talk about how do you wrap this all together to help you build confidence in your trading. So those are the things we're going to go over here today. Now, before we jump into the learning experience, I just want to poll the audience here. So I just launched a quick poll. I just want to understand, what is the options experience level of the audience here today? How many of you are brand new? How many of you are just starting? How many of you have been trading for a while? And how many of you consider yourself experienced in options trading? Okay, so we have half the votes in already. A third of you say you're just starting out, 10% of you saying that you're brand new, 50% of you say that you've been trading for a while, and 7% of you say that you are very experienced with options trading. So with more than 2/3 of the votes in, I certainly think that we have a pretty good wide audience here. as you can see here. 10% of you saying that you're just getting started, 31% saying you're just starting with options trading, but you've started options trading, but you're still brand new. So especially if you're just starting out and you're trying to learn how to build confidence, hopefully today's session really helps you solidify that. For those of you that are getting started, this hopefully shows you a path for that getting started and what that might look like. For those of you that have been trading for a while, this is designed to make sure that you have all the right best practices for trading these types of strategies. And lastly, for those of you that are very experienced, hopefully you'll also learn something here as well. So let's go ahead and get started. But the primary question that I want to help every investor walk away from today's session is an understanding as to how you can generate consistent income with optimal credit spreads and build confidence in your options trading strategy. Now, how many of you are currently trading options, but feel that you're not quite getting the consistency that you're trying to get? Please type 1 into the chat window if you feel that you've been trading for a while, but you're not quite at that point where you feel that you're consistent in your trading. Okay, I see a lot of ones. Now, I've been a market strategist for over 15 years now. And this is the one thing that I see a lot of investors struggle with. So first, we want to define the strategy, but the last slide that I'm going to talk through is actually the most important in helping you gain consistency. Make sure you stay till the end to make sure you see every single step of the way, because if you miss that last step, it is going to cause some inconsistencies in your trading. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. Like I said, I've been a market strategist for 15 years. I started my career in currency trading, for those of you that trade Forex, heavily in technical analysis before I started trading futures and options. And I co-founded this company 8 years ago to build a better options experience for all traders. Not only do we provide the technology for you to analyze and find options trades, we do options education and send options alerts to you. And for those of you that are just starting out with options or trying to figure out how options fits into your portfolio, a really good way to go about doing that is actually watching me on CNBC every single Friday afternoon at 5:30 p.m. on a show called Options Action. This is a show where it's the only show on primetime TV that's dedicated only to options trading. So me, Mike, and Carter, the 3 hosts of the show, we will break down every single week 3 opportunities. We will give you a stock or an ETF. We'll show you whether we're bullish or bearish on that stock or ETF based on fundamental and technical factors. And then most importantly, we show you how to leverage that directional view with limited risk using options. And it gives you a very good exposure, if you will, to various option strategies, the risks and rewards of each one, and when a strategist like ourselves would utilize that strategy in the current market environments based on our outlooks. So if you're figuring out how options fits into your portfolio, or you're trying to figure out what option strategies you might want to take a look at this show, because we pretty much cover a pretty wide gamut of different option strategies, of which one strategy that I use the most, for those of you that have been following me on CNBC for a while, is credit spreads. There's a reason that I trade credit spreads the most. It's the one that allows you to win more than 50% of your trades. And it's one that really allows many investors to gain that confidence by winning more often than not. So let's go ahead and get started. But before we do, I just wanted to ask one other question. How many of you have traded a credit spread before? Yes, no, or you're not sure? And James, to your question, yes, we will have a Q&A session here at the very end. And Raymond, good afternoon to you as well. Greg, thank you so much for saying that that's the best show out there. I appreciate that. Okay, so with 73% of you voting, 70% of you have traded a credit spread before. 27% of you have said that you've not traded a credit spread before, and 4% of you said that you're not sure. Okay, so the vast majority of you have traded credit spreads. So that helps us get some of the initial education out of the way. But for the 27% of you that have never traded a credit spread, we're going to give you an introduction to the strategy so that you understand it before we dive into best practices and examples and things like that. And examples will also help you better understand each one of these strategies. So let's first talk about what is a credit spread. Now, the best way to learn really is by example. But before we go through the actual example, a credit spread is an income generating strategy. It's a strategy that generates income for the directional view that you have in an underlying stock. And it's generally what we call a mild directional view strategy, meaning it's for when you have a relatively loose directional view. You don't necessarily have a strong directional view. You're not saying that I think the stock is going to jump 10% in the next month. You just think that it's going to drift higher, a little bit higher, a little bit lower. You have a mild directional view. That's generally speaking the best time for selling a credit spread. Now, the reason that I want to teach this strategy to every investor, and I think it's suitable for every investor, no matter your risk tolerance, whether you are aggressive, conservative, small portfolio, large portfolio, why I think it's suitable for almost all investors, even beginner options investors, is because it's a very forgiving strategy. It has a higher probability of success, which for me, I believe for many investors, whether you are starting out or experienced, it helps build confidence. When you're able to win more than 50% of your trades, you're going to be more confident in your trading. You're going to want to learn more and want to figure out ways to optimize and better your strategy. But if you're winning only 30, 40% of the time, it's just hard to continue to want to pursue that type of trading. Even though lower probability of profit trades may generate a better risk rewards, but many times when you're only winning 30, 40% of the time, you're less inclined to spend the time to learn. And so when you start out winning 50, 60, 70% of the time, you're more inclined to learn more and figure out how do I make it even better. And most importantly, it is a both limited risk and limited reward strategy. And that's part of why it's suitable for everyone, because you can know exactly how much you're risking and how much you can potentially make. And this way, before you get into any single trade, and we're going to talk about why this is designed to help you build confidence, you can't lose more than what you want to lose on a trade. So you can control exactly how much you want to risk. And that's the important part, especially for those of you that are brand new, that you don't jump into strategies where you don't understand the risk. Does that make sense? Please type 2 into the chat window if that makes sense to you. Perfect. I see a lot of 2s. Great. So let's just jump into an example, because I still think looking at an example is still the best way to learn. So here's Moderna, and I took the screenshot here yesterday. Moderna at the time was trading around 157.5 or so. As you can see, Moderna has been recently on a bit of a tear, pulled back here, and is starting to bounce a little bit higher here in terms of the stock. So an example of a credit spread is to use and here I'm going to use a July 2nd, 2021 expiration. And we're going to come back to why I chose the July 2nd weekly expirations, because there are very clear best practices as to what expiration date you should choose. So we're going to come back to that. And then what I'm going to do is I'm going to sell an at the money put option. In this particular case, because the stock's at 157.65, I'm going to sell the 157.5 put. Now, for that, I'm going to collect $13.70 in terms of a credit. Now, for those of you that have experienced options trading or have seen or have looked at options trading in the past or trade options currently, you know that when you sell a put, you have a fair amount of downside risk, because selling a put looks sort of like this. As the stock declines, you lose more and more money. So instead of taking on all that risk, what you can do is you can buy a lower put against that. Let's say in this particular case, paying $5.80, the resulting trade is a trade that looks like this, where you have a limited potential reward, but also limited potential risk. And you know exactly how much you can potentially make and how much you can potentially lose. Now, in this particular case, I'm going to collect a net credit of $7.90, which is the difference between the $13.70 credit that I receive plus the $5.80 debit that I paid. The difference between those two numbers is $7.90. Now, when you sell a credit spread, the reason we call it an income generating strategy is because that is the most I can make. So when I sell a credit spread, the most I can make is $790 per contract of this Moderna credit spread that I sell. My max risk is $960. Now, we're going to talk a little bit about how to calculate the difference between these two, how to calculate max risk, how to calculate max reward, how to calculate the ratio between the two, which is a very important number to pay attention to when we're selling a credit spread. So here, I think the best way to learn about a credit spread is just to look at the outcomes when I sell a credit spread like this, okay? Now, this is a bullish credit spread. You do this when you're bullish on the underlying stock, meaning I think the stock is going to rise higher going from here. So what I have here on my chart is effectively three levels that are important. So remember, I sold the 57.5 put. I bought the 140 puts against it, and my break-even point is 149.60. That's the point at which this strategy breaks even. So here's a chart of Moderna yesterday, just around 170 or so, 157 or so. And the July 2nd expiration, just to put it into context, is around right here. So what this gives you a sense for is where does Moderna stock will likely be sometime in the future. It can go up, it can go down, it can go significantly up, it can go significantly lower. And the question is, how did this strategy perform in all of those scenarios? So let's take a look. First scenario we're going to look at is if the stock closes above 157.5 at expiration. That's the higher strike price that I've sold. I sold the 157.5 put. Now, with the credit spread like this, as long as the stock stays above 157.5, which is this top line right here, if the stock stays above this line, I'm going to make my full profit, which is $790. So it doesn't matter if Moderna is up here, if it's over here, if it's over here, or even if it's over here, which means that the stock can actually decline a little bit. I will still make $790 profit in all of these scenarios. Doesn't matter if the stock goes significantly higher, a little bit higher, or even just completely goes sideways, I make my full $790 profit. That is the only strategy that you can trade in any universe where this strategy will actually make money if Moderna does not move, okay? And that's part of why it's such a forgiving strategy, meaning if you're right on the directional view, so meaning Moderna does move higher, yes, you will profit your $790. But even if you're wrong and Moderna simply just moves sideways, you will still make $790 profit. Does that make sense? Please type 3 into the chat window if that makes sense to you. Okay, so that's first of all, why this is a very forgiving strategy. The second scenario is if the stock is between the higher strike that I've sold, 157.5, and the break-even price of this strategy, which is 149.60. So if, let's say in this particular case, I think Moderna is going to go higher, but it doesn't and actually starts to move a little bit lower. It doesn't move significantly lower, it moves a little bit lower between 149.60, which is this line right here, and the 157.5, which is the short strike that I've sold. So if it ends up somewhere in between these two levels, what I have is some profit. I don't make my full profit, but I have some profit, somewhere between $0 and $7.90. Basically, if I'm closer to the top line, I'll make $790. If I'm closer to the bottom line, I'll make $0. And it's just basically a various range depending on how close I am to the bottom line or to the top line. The closer I am to the top line, I make $790. The closer I'm down to the bottom line, I make $0. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Perfect. So second to last. Now let's say the stock is between the lower strike, $140, and the break-even price. So the break-even price here is this line. The lower strike, 140, is right here. So I believe Moderna is going to go higher, but instead it ends up somewhere in between the lower strike and my break-even point. At this point, this is really where I have some loss, right? I got the directional view wrong, so I'm going to have a loss. Now, the loss is going to be somewhere between $0 and $960 because the max risk is $960. The closer I am to the bottom line, the more I'll lose $960. But the closer I am to the top line, the closer I lose $0. And lastly, only if the stock breaks below my lower strike, $140, do I lose my full $960. Now, the important part here is that if it goes below $140, I lose $960. But if the stock even goes to zero, if the stock for some reason goes bankrupt, or some really bad news comes out, Moderna vaccine is no longer safe for consumption, we have to pull back all Moderna vaccines in terms of COVID-19, the stock goes to zero, you lose only $960. You control the amount of risk that you take with this type of strategy. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you, okay? So those are the possible outcomes. So let's review that, right? I think Moderna is going to go higher. That's why I sell a credit spread. So if it goes higher, I'm profitable. If it goes sideways, meaning I don't get the directional view right, but I don't quite get it wrong, I still make the same amount of profit than as if the stock went higher. If the stock goes marginally lower, I still make a profit. So I can actually get the directional view wrong, but still make a profit. And if I get the directional view really wrong, that's when I lose money, but I control the amount of losses. Now, think about this, right? This is the break-even line. So as long as the stock is somewhere in here, I'm profitable. Only if the stock is down here do I lose the full $960. So this is really where we call it a forgiving strategy, because to be above this line, the 149.60, you generally have about a 60% chance of being in this zone, of making about some profit, and about a 50% chance you're going to make the full profit, right? And then if you look at this bottom line, 140, you really have to be concerned about the stock being below 140. That's when you lose the full loss. You only have about a 25% chance of being below 140. We're going to talk about how I know these probabilities. It all comes down to the rules that we use when we select our strike prices. Why we select these very specific strike prices is because we want these probabilities in our favor. 60% chance that we're going to make some profit, with a 50% chance we're going to make full profit, and only a 25% chance of losing our full loss on this particular trade. So that is the potential outcome that you have with a credit spread. So when should you use a credit spread? That's really where we go back to this chart. Think about this chart, right? This is where I showed you. You make most of your profits here, right? If the stock just stays where it is or moves higher. So how do you maximize the probability of that happening? So if you look at a chart, this is the chart of Moderna. Notice how the chart goes up, goes down, goes up, goes down, goes up, goes down, goes up, goes down, goes up, right? So in an ideal world, when do you want to sell a credit spread? You want to sell credit spreads in these types of conditions, when they're near a bottom of a trading range and they're more likely to bounce higher, okay? Now the question is, how do you go about doing that? How do you identify stocks that are oversold? Now, this is really where many users will turn to technical analysis. We turn to technical analysis, either moving averages, or we use some type of indicator like stochastics. Wherever it gets oversold, these are your opportunities to buy for bullish strategies. And when they're oversold, those are your opportunities to sell. So generally speaking, when we talk about when should you sell a credit spread, you generally want to do it near a support or resistance level, or if the stock or ETF that you're trading is overbought or oversold. And many times you might find a stock trades in a trading range. So this is where a stock perhaps is within a range-bound market. And whenever it's at the bottom of the range, those are your opportunities to sell a bullish credit spread. When they're at the top of the range, those are opportunities to sell a bearish credit spread. But there's also a few other things that we're going to discuss here today, because not only do you want to look at optimal times to sell a credit spread, you also might want to look at optimal opportunities. And since 69% of you said that you've sold the credit spread before, You may have heard of using volatility to determine when it's best to sell a credit spread. How many of you use volatility to determine selling a credit spread like IV rank or IV percentile? Please type yes into the chat window if you have used volatility before or currently use volatility to determine when it's time to sell a credit spread. So I see a lot of yeses. I also see a lot of no's. And we're going to talk a little bit about volatility, measuring it, and when it's useful for credit spreads. So I'm going to show you why using just high volatility environments is not a good way to sell credit spreads, at least not in the most generic ways. That you want to more specifically look at volatility skew, which is far less used by traders, but we want to show you how you can scan using volatility skew, because high volatility environments as a generalization is true, but many times you'll find that it's actually in practice not practical. So let's talk a little bit about what are the optimal credit spreads. So before I talked about when the Moderna is trading at 157.5, that we sold the July 2nd 157.5, 140 put credit spread. Why did I choose that expiration date, and why did I choose those strike prices? So this is really where we have back tested this strategy to death over the past 15 years with every single possible combination of expiration dates, strike prices, different deltas, different rules for entry, different rules for exits, and we have found the optimal credit spread. And that is roughly 45 days to expiration. So as of yesterday, the July 2nd was the closest weekly expiration to 45 days to expiration. That's why we chose the July 2nd. We always want to sell the at the money, or what we call a 50 delta strike price. So the current price of 157.65, the closest at the money strike is the 157.5 put option. And then what we want to buy is an out of the money call or put, which is a 25 delta. And that's how we arrived at the 140 puts. So we always select strike prices based on deltas, because deltas gives us probabilities. It gives us the probability to know exactly that roughly 60% of our trades will be winners and make a 50% chance of making full profits. We have a 25% chance of having a full loss. And the question is not just the probabilities, but also the ratios of the risk to reward that you get between these two numbers. So we're going to talk a little bit about that, because what we generally want to have is for every $1 that we risk, for every $1 in income that we receive, that we never risk more than $2 in risk. If we risk more than $2, that's going to become a problem down the line. So that's why we always use delta. Delta tells us the probability of the stock being in the money by that price. So every single strike price has a delta, no matter what platform you use. Whether you use Thinkorswim, whether you use Fidelity, Schwab, there is a field called delta. Delta approximates the probability of that strike price being in the money. And that's why we always use delta to choose our strike prices. That's how we gain consistency. If you're eyeballing strike prices on your own, or if you're using 5% or 10% or $5, you're not going to be able to gain consistency in your trading. By using probability-based approaches, you're going to know that 60% of your credit spreads will be profitable, 50% of them will have its max gain, 25% of them will have its max loss or potentially its max loss. And when you have those kind of defined variables and you know exactly how much you're risking, how much you can potentially lose, you're going to be able to gain consistency, because you know what the potential outcomes are. If you don't know what the potential outcomes are, or if they're different all the time, that's when you lose your consistency. Does that make sense, everyone? Please type 6 into the chat window if that makes sense to you. Perfect. Now, the golden rule here is that when you select a 45-day, you sell the 50 delta call or put, and you buy back the 25 delta call or put. The minimum income that you want to collect on a credit spread is 1/3 of the width. The width refers to the distance between the two strikes. So when I'm selling the 157.5 and the 140 strike, that is a distance of 17.5. So what I want to collect is always 1/3 of that. So as long as I can collect 1/3 of 17.5, so just to do a little bit of math here for you guys, 17.5 times 0.33, that comes out to be $5.75 is the minimum income that I want to collect if I'm going to sell a credit spread for $17. That's $17.5 wide. Now, in this particular case, I'm collecting $7.90, which is well above the $5.77 minimum that I'm looking for. And we're going to talk a little bit about why we have this minimum, which is another important piece in gaining consistency in your trading. And more importantly, gaining profitability in your trading. So it's one thing to be consistent, it's another thing to be profitable, right? So if you want to be profitable, make sure that the credit spreads that you sell, you're collecting at least 1/3 of the width. And we're going to talk a little bit about why. So the one thing to remember about a vertical spread is the fact that the distance between the two strikes. So if I'm selling the $100 call option and buying the $110 call option, if the distance is $10, right? The distance between these two strikes, whatever I collect in income. So if I collect 1/3 of the distance, which is $3.33, the rest that I have of that $10 width is going to be my risk. Okay. So whenever you have a vertical spread, the distance between the two strikes is what you're playing with. The income that you collect is going to dictate what the remaining amount of risk is going to be. So if I collect at least 1/3 of the width, then I know for every $1 in potential reward that I make on this trade, I am never going to risk anything more than $2. Actually, I'm going to risk exactly $2. So in order for me to be profitable at this type of strategy, I have to be right 67% of the time just to break even. Meaning, if let's say I trade this strategy multiple times, I win $1, I win $1, and then the next trade I lose $2, and I win one, lose two, win one, lose two, win one, lose two. That's how I'm going to break even. I'm not going to make any money. I'm not going to lose any money. Okay. So obviously, we're not here to just break even, right? We're here to make money. So the question is, how do you find an edge? How do you trade the strategy to be profitable? That's really where we want to find an edge. So whenever we sell, let's say a 100, 110 call spread or a credit spread, we want to try to collect more than 1/3. 1/3 is the minimum, but what we want to try to collect is a little bit more than 1/3. So if let's say I'm able to collect 40% of the width instead of 33% of the width, what that does is by increasing my potential income, what I'm doing is I'm decreasing my overall risk, because if I collect 40% of the income in terms of income, then I'm only risking 60% in terms of risk, versus the prior one, when I make 33% income, I risk 67%. So my risk to reward gets a little better if I'm able to eke out even just a couple of percentage points, right? The difference between 33 and 40 is only 7%, but it changes the risk dynamics entirely, because if I'm able to collect 40% of the width, then for every $1 in potential reward, I'm only going to risk $1.50. Before I was risking $2. Now I'm risking only $1.50. Now I only need 60% winners to break even. So what that trade looks like is, now if I make 2 trades and I win $1 twice, and the third trade I lose money, I only lose $1.50. My net gain here is I win 50 cents. And every single time I do this, every time I go through 3 trades, 2 winners and 1 losers, 2 winners and 1 losers, I gain 50 cents. That's how I'm able to gain that edge in trading. Now, the question is, how do you find these? That's the tricky part. How do you find these? Now, before we jump into how to find these, I do want to discuss one thing, because many traders are going to ask me, why do we sell at the money puts? Why do we sell at the money calls? And I've already seen quite a few questions along these lines as I was going through those specific strike prices. And the answer is, if you sell, I see a lot of credit spread investors will sell out of the money credit spreads. How many of you that are currently on the session today sell out of the money credit spreads, where you sell options that are further away, that have higher probability of profits? If you do that, please type yes into the chat window. Frank says used to, and I think that means something, because used to means that many times he may have done that and perhaps have had a huge loss as a result of it. Now, here's the thing about selling out of the money credit spreads. And many times, I see people will say it feels safer. Let me just read some of these, and I think this is very insightful, right? Jamie said he used to. Ray says he currently does. Uday says he feels safer to do it. David says he used to. Tony says, I got burned doing it. And that's usually what happens, right? And I'll tell you why selling out of the money credit spreads seems on paper far better than doing what I just taught you, which is selling at the money credit spreads. And usually I'll get responses from people who will say selling at the money credit spreads gives you very little buffer. You have to be right on the directional view, and you're absolutely right on that. But the downside to the flip side of that, which is selling an out of the money credit spread, which gives you a much bigger buffer. It gives you the ability to have much wider, much more forgiving strategy. You can be really wrong on the directional view and still be profitable on that trade. But when you sell these really far out of the money credit spreads, what you have is very high probability of success, but you have risk to reward ratios that are really far out of whack. Many times for every $1 in potential income that you receive, you're taking on $5, $6, $10, $20, $50 worth of risk. I've seen people risk thousands of dollars for just $50 in potential reward. And the upside, or I wouldn't even say the upside, the reason that people like to take on those types of really skewed risk to rewards is because you have very high probability of profit. If you sell those trades, you're likely just going to see win after win after win after win after win after win. You're going to say to yourself, I am a genius. I have found a money printing machine. And many times that will work quite a bit. Many times it could work for months, sometimes even years. And you think to yourself, yes, I've really found the golden ticket with respect to trading. And it's a bit of a fallacy. And we've back tested this over and over again. And there are periods of successful periods where this strategy works quite well for a long period of time. But your success in this strategy is completely dependent on luck, meaning what year did you start this strategy? If you started this strategy in 2010, you would have done okay. If you started this strategy in 2019, you would have had your account handed to you. So it's one of these strategies that we call picking up pennies in front of a freight train. You're going to win a lot. You're going to win very little quite often. And then once in a while, you're just going to get completely run over by the market, where that you think to yourself, there's really low chance that I'm going to, for every $1 that I make, I'm going to lose $50. And all it takes is one coronavirus to come in and wipe out your entire account doing that. So, and I see a lot of investors, kind of reiterating kind of their experience doing this, right? High risk, low reward. It is something that on paper sounds very good, but I warn investors, don't do that. When you trade strategies like this, for every $1 I potentially make, no matter how bad the trade goes, the coronavirus hits, the global financial crisis hits, no matter what, my risk is only going to be 1.5 times my potential reward. I don't have these black swan events that just blows huge holes in my portfolio. So that's why it's so important to utilize these at the money spreads. You're going to feel like I have very little breathing room, but still you have 60% chance of success. And the reality is it doesn't matter how often you win. You can win 90% of the time, but if you lose money on the 10% of the time, that wipes out all of the profits that you make in that 90%. What good is that, right? Making money 90% of the time, making money 99% of the time doesn't mean anything if that 0.1% of the time you blow out everything. So don't focus too much on probability of profit. If you're focused too much on probability of profit, chances are you're missing out on a very important piece of the picture. So be very careful in this when you're using these types of really far out of the money credit spreads. The second thing I want to talk about is volatility, because I see a lot of investors, before I asked how many of you use IV rank to determine when to sell credit spreads. And for those of you that have known me for a while, you know that I'm a good friend of Tom Sosnoff. I respect him very much, but the one thing that I have a gripe with him is the fact that he teaches the concept of using IV rank a little bit too much. He teaches you that you want to sell options when IV rank is high, you want to buy options when IV rank is low. But the problem with that is that IV rank only measures 30-day at the money options. And it compares what the current 30-day at the money option is compared to the last year. But unless you're just trading the 30-day at the money option, it's not very useful for selling credit spreads or trading debit spreads where you're trading the 50-25 delta. You have two options, and the at the money options don't really tell you much about the 25 delta, and it doesn't tell you the relation between the at the money and the out of the money option. Versus when you look at volatility skew, and this is something that's very uncommon for investors to use, the skew actually can tell you the difference between the 50 delta and the 25 delta, the two options that you're actually trading. And it measures it in real time, and it measures what you're actually trading. And that, for my purpose, is more important. And I'm going to show you why. So I have on my chart here, this is Moderna based on today's implied volatilities. The green line are the July weeklies, and the yellow line are the July monthlies. And this is a chart of implied volatility on the right-hand side, and then the strike prices here on the left-hand side. So what we really care about is the 155 and the 140 strike prices. Those are the two strike prices that we're buying and selling. Now, what IV rank tells you is the shape of this entire curve, whether it's here or down here, meaning it's just telling you as a general sense whether the curve is relatively elevated or relatively low. It doesn't tell you anything about the shape of the curve. It doesn't tell you whether you're buying one that's high or buying one that's low, but in reality, that's what you're trading. So when you're looking at this curve, what you can see is that if I traded the July monthly options, which is the yellow line, and I sold the 155s, if I'm selling the 155s, selling the 155s, that has an implied vol of about 60%. And I'm going to buy the 140s, which has an implied vol of about 63%. So I'm selling the implied volatility that's lower, and I'm buying the one that's higher. That's the opposite of really what I want to do when I'm selling a credit spread. But you can't tell that from just looking at IV rank, because also if you look at Moderna's IV rank right now, it'll tell you that IV rank is 4%, which pretty much disqualifies most people from selling credit spreads on it. But when I look at the July weekly options, which is the green line, the 155s have relatively elevated implied volatility. So I'm selling the higher volatility, and then the 140s is relatively lower. I'm buying the lower volatility. So I basically have reversed this implied volatility skew that existed in the monthly options that is reversed in the weekly options. So despite the fact that IV rank is very low, I was able to find a skew that presented an opportunity for me in this market. It provided the ability for me to collect roughly 40% of the width. So let's just review this, right? This is a $17.50 wide spread, but I'm collecting $7.90. So how much is $7.90 out of a $17.50 spread? I'm collecting, in this particular case, 45% of the vertical width. And that is that small skew, that 3% skew that I showed you, the difference between the monthly and the weekly options. That's how big of a difference it makes in your trading strategy. Doesn't matter the fact that Moderna's implied volatility rank is extremely low. When there's skew that's available, this puts the edge in your favor. So that's why when you're looking at this, not only am I here, I'm risking, my income is 45%, which means my risk is only 55%. That is the edge that you want to seek when you're selling credit spreads. Does that make sense, everyone? Please type 7 into the chat window if that makes sense to you. Now, many of you are watching this and you're going to say, how the hell do I find that? How the hell could I have possibly found this particular trade? And that's really where OptionsPlay does the work for you. We actually scan the markets for these skew opportunities and present them to you from best to worst. So what we have here is what we call a credit spread opportunity report. This is, we already scan for very liquid optionable symbols. So we throw away symbols that are not liquid. We're not going to bother finding credit spreads that you're not going to be able to execute. And we find credit spreads that have a minimum of that 33% vertical width. So again, minimum, we always want to collect at least 1/3, but reality, what we're trying to find is the ones that are collecting more than 40% of the width. Closer to 40% really puts the risk reward in our favor. That's really where we find this skew in our favor. And then lastly, what we want to do is we want to line it up with a directional edge. So as I was showing you here before with Moderna, you want to find stocks that are oversold, that are likely to bounce higher for bullish opportunities. And you want to find stocks that are overbought that have more of an opportunity of declining. Now, the one thing I will say is that you have far more bullish opportunities than bearish opportunities, simply because the markets drift higher 60% of the time and drift lower only 40% of the time. So statistically speaking, bullish opportunities are going to give you an edge. That's why most of the trades that you find in our opportunity report are bullish. And our report will basically give you the symbol and the direction. So for example, a stock in a specific bullish opportunity. It'll give you exactly the credit spread details, which expiration date, what strike price to buy, which strike price to sell. It'll tell you the risk to reward, because it'll tell you how much premium you're collecting with respect to the width. And it calculates for you based on the width percentage that we're talking about. The closer you are to 40% or higher the percentage of the width that you're collecting, the bigger the edge that you receive. And then you also have important information. Some of you still like to use IV rank, and I encourage you to use IV rank sometimes as a disqualifier. Sometimes you have two stocks next to each other, like for example, these two, right? One has a higher implied rank than the other one. You might choose the one with a higher implied rank because they collect the same amount of width. And you also have earnings date, right? So sometimes, if you have an earnings directional view, you can go ahead and trade them on earnings. But sometimes you may not have a directional view. Fitch, maybe you have no idea the directional view on Fitch. So maybe you don't want to trade them around earnings. So for example, this one, Kroger was reporting earnings in 14 days. Maybe you don't have a directional view on Kroger, so don't trade that. Only trade the ones that you are either don't have a directional view and they don't have earnings coming up, or if they have earnings coming up, make sure it's one that you have a directional view on. And lastly, this report is updated every single hour so that you have fresh opportunities in your OptionsPlay platform every single hour that finds these types of trades in your edge. So talking about, so this shows you how to find those opportunities. Now let's talk a little bit about managing these trades, because this is the 4 most important rules for you to stay consistent in your trading. Number 1, you only want to enter credit spreads that collect at least 33% of the width. So you can do it manually, but if you want to use our report already does that work for you. Now, the next 3 rules are for managing a trade. So we've talked a lot up till now on how to get into a trade. What are the rules to find an optimal credit spread, what to look for, what expiration date, what strike price, what percentage of width you want to collect, all of these rules for entering this trade. But once you're in that trade, how do you manage it? Just like how we have these rules for entering the trade, we also have very mechanical rules that have been back tested over tens and tens of thousands of trades as to how you should take profits, or when you should take profits, when should you cut your losses, and when should you get out of a credit spread. And with a credit spread, it's a little complicated, but there's 3 triggers to get out of a credit spread. Whichever one of these triggers hits first, that's your rule to exit the trade. So the 3 rules are: you either take profit at 50% of the max gain, you either cut your losses at 100% of the max gain, or you exit at 21 days to expiration if it does not hit this rule or this rule by the time that the 45-day credit spread gets to 21 days to expiration. So just as an example, if let's say I'm selling a credit spread that's $10 wide and I'm collecting a total of $4 on this $10 wide credit spread. So it meets the 33% width minimum, right? Because I'm collecting 40% of the width. What I want to do is I want to take profits if I make 50% of the max profit. So if I collect $4 on a credit spread, that's the most I can make on that trade. So if I make 50% of that, which is $2, it's time to take your profits and simply move on to the next trade. If this $4 credit spread that I sold starts to move against me and is now trading at twice the premium that I sold it for. So I sold it for $4. It's now trading at 8, which means I've lost 100% of the max gain of that trade. Then now it's time to get out of the trade. That's to take a loss, right? You either take a $2 profit or a $4 loss. And the third rule is that if this trade gets to 21 days to expiration and it doesn't trigger a stop loss and it doesn't trigger a take profit, it's time to also get out of the trade. This comes down to gamma risk. It's avoiding gamma risk in the last 21 days, and you're avoiding assignment risk, because as you hold a short option closer to expiration, you have the assignment risk. So closing out the trade 21 days for expiration avoids that assignment risk. I have traded this strategy thousands of times, and I have never been assigned on a short put spread or a short call strike. And the reason for it is because you stick to the 21-day rule. That is the best way to stay and avoid assignment. And a lot of you are concerned about assignment. So the best way to avoid it is making sure that you exit the trade 21 days to expiration. As far as what gamma risk means, gamma risk is the risk that you have with the short strike losing a fair amount of premium with respect to the amount of theta decay that you earn. Because as a short strike gets closer and closer to expiration, you're going to get faster and faster decay. That works in your favor. But as you get closer and closer to expiration, that short strike also gets very sensitive to underlying moves. So that sensitivity goes against you, because if the trade starts to go against you, that sensitivity is going to compound to losses very quickly. So the question is at which that sensitivity starts to outweigh the acceleration that you get in time decay. And that cutover, if you will, happens at about 21 days, which is why these rules are in place. Now, when you're trading this, one of the most important rules to building confidence, because you can follow every single rule that I've just showed you here, but you can still technically blow up your account very, very easily if you do not follow this last rule. So for all of you that you've learned about this, you want to make sure that we talk a little bit about building your confidence, okay? How do you build confidence in your account long term? It all comes down to risk management, because if you don't follow these risk management tools, you can gain consistency, you can start to learn how to trade, you can start gaining consistency. But what I see time after time is that investors, when they start off, they'll start with small amounts. They'll trade 1 contract, 2 contracts. As they start to gain some consistency, they start to leverage up their trades. They go from 2 contracts to 4 contracts to 10 contracts to 20 contracts. Next thing they know, they have 1 bad trade or 2 bad trades that wipes out a large percentage of their accounts. How many of you can relate to that? Please type 8 into the chat window if you can relate to that, where you slowly built up confidence, you were trading small, and then you kind of got too big and you had 1 or 2 trades that really wiped out a large percentage of your account. So I see a lot of 8s. And in my experience of doing this for 15 years, this is one of the most common reasons that people say that they have not gained consistency yet in their trading. And many of you said in the beginning of the session that you have not quite received that consistency in your trading. So when it comes to trading these types of trades, there's one golden rule, and that is that you should never risk more than 1 to 2% of your total account value per trade. No single trade, when you have the max risk, should ever wipe out more than 1 to 2% of your total account value. So you have to work backwards. This is an account value table, right? So, no matter where you are between $5,000 and $1 million, look at what 2% is, right? So for example, if let's say you have a $50,000 portfolio, that means your 2% rule is $1,000. So whenever you trade a credit spread, such as in Moderna, every single credit spread that you sell has a has a max risk, right? So when we look at Moderna here, the max risk here is $960. So if you have a $50,000 portfolio, then $960 is within the 2% rule. Now, that means that if you have a $50,000 portfolio, you should never trade more than one contract of this strategy, because one contract of this strategy will risk $960. If you traded two contracts, you would risk roughly $2,000. That would be 4% of your total account value. And the reality is that you cannot get too comfortable with trading. Even when you win 60% of the time, you still have that 25% chance you're going to lose that full maximum loss, right? That means out of 10 trades, 2.5 of them will have that full loss. So you could have 10 trades, have 3 losing trades in a row. And if you're risking 10% of your account per trade, that's going to blow a 30% hole in your portfolio. It has nothing to do with how good of a trader you are. Just that there are times where the market just doesn't go in the direction that you expect it to, and you have 2 or 3 losing trades in a row. That is perfectly normal to have. The question is, are those 2 to 3 losing trades in a row going to blow a hole in your portfolio? If you don't follow these types of rules, you're absolutely going to have times throughout the year where 2 to 3 losing trades in a row is going to blow this wide hole in your portfolio. So when you talk about not gaining confidence or not gaining consistency in your trading, it has nothing to do with your strategy. You're not trading the markets wrong. You're not reading the markets wrong. You're not following the wrong people. What you're doing is you're trading too large of a size. So use this rule to your advantage, because if you stick to this rule, right, every single trade doesn't exceed 2% of your trade, then even 3 losing trades in a row is only going to blow a 6% hole in your portfolio, which means that you still have 94% of your portfolio left to continue trading. And that's how you're going to gain consistency. Now, the other thing that I'm going to have to teach you is that if, let's say, you only have a $10,000 portfolio, that means the most you can risk is $200 on each trade. So if you come across this Moderna trade, what you should do is you should not trade it. So this is just, so it's really important that you also look at what is your max risk of each trade, because if you're looking at our credit spread report, we tell you what the stock price is. If you have a small account, you really should be avoiding the $300 stocks, the $500 stocks, even the $200 stocks may be out of your range. You might want to focus on the lower price stocks. So our credit spread report allows you to filter based on your account size as well. So if you have a small account, stay away from the high price stocks. Look at the $30, $40 stocks. But if you come across a Moderna trade and you have a $10,000 account, don't even think about trading it, because if you do, then you're likely going to be in that scenario where you're going to blow a large hole in your portfolio and you're going to say, I'm lost, I can't gain consistency in my trading. But it has nothing to do with how you're trading. It's not that you're a bad trader. It's not that you're using the wrong strategy. It's not that you're bad at reading the markets. It's all based on just using too much of your portfolio in order to trade. Does that make sense to everyone? Please type 9 into the chat window if that makes sense to you. So for those of you that have been frustrated or feeling that you're struggling with trading for a period of time, don't be too and especially if you can trace back the result of that is to using too big of a portfolio or trading too large size, then you can be confident in your strategy. You can be confident in your indicators, and you can be confident in the way that you're reading the markets, because those are not the problems. Nine out of 10 times when I work with a trader and they tell me they're struggling with trading, they tell me they're frustrated, and they tell me they're not gaining consistency, it usually isn't because they're a bad trader. It's usually because they're exceeding this golden rule of risk management. And when you exceed this golden rule of risk management, you could be the best trader in the world and still have these large holes blown in your portfolios just because of the timing of the market. There's nothing that you can do to avoid a bad month in the markets. And what you can do as a good trader is to make sure that a bad month in the market doesn't blow the 30-40% hole in your portfolio that basically leaves you with nothing left unless you deposit more money in order to trade. So covered a lot of things here in the last hour. I know I threw a lot of things here at you, and this is really where made this an action-packed hour. I tried to jam as many things in there as possible for you. Now, for those of you that are members of OptionsPlay, you currently have a free trial. You already have access to everything. But for those of you that are first-time users of OptionsPlay, you have a full 30-day trial to everything that I just showed you here today. The OptionsPlay platform, you can get a copy of the slides. You can get a recording of today's session. If you sign up for a free trial here, we have a free webinar offer, a free 30-day full trial to the OptionsPlay platform. You get access to the credit spread report that I just showed you here today. You get live reports every single hour so that you can find these opportunities, and you get access to my education. I do this every single week where I teach investors how to trade, best practices for different option strategies, and we do weekly market outlook sessions where I talk to you about the markets, my views on the markets, and you can watch me on CNBC, and you'll be able to show you the trades that we make on CNBC. We break them down for you and give you both a technical fundamental view and as well as option strategies. Now, not only do you get that on CNBC once a week, we do that every single day for our members. So you have a free 30-day trial to the OptionsPlay platform by signing up using the link here on your screen, which I will post into the chat window here. So if you go into your chat window, this link right here, optionsplay.com/webinar-trial. If you go to that screen, you'll be able to sign up for a free 30-day trial and get access to everything. No credit cards needed, and you'll get access to the free 30-day trial. Before we open this up for Q&A, I do have one last question to ask. Just one last poll. Do you currently have a free trial or membership to OptionsPlay, or if you're a first-time user of OptionsPlay? I just want to get a quick count here. Okay, so 25% of you said you're currently on a free trial. So for those of you that are on a free trial, you already have access to everything. I'll show you how to access everything here in 1 minute. 34% of you, you're a member, so you already have access to everything. You've already seen many of these things. Hopefully this helped you understand how to utilize this. And 42% of you said that you've never used OptionsPlay before. So sign up using this link here. It's a free, completely free 30-day trial. You'll get access to everything. And in just 1 minute here, I'm going to show you the credit spread report. We'll do a live trade together just to show you how to use it. And you can sign up using optionsplay.com/webinar-trial. So let's just take a look at the live report. This was generated here before the close at 3:25. And the top one here is actually Moderna. Moderna was one of the trades yesterday. It's another trade here today. This is because Moderna is still below the 21-day moving average. It's still oversold. So directionally, we still think it's an opportunity. And Moderna, as you can see, closing at around $160. But if you sold the 160, 135 put spread, you're going to collect exactly $10 out of a $25 wide credit spread. That's 40% of the width, even though Ivy rank is only 4%. A lot of you that are using Ivy rank, you're going to say this is not suitable. But as you can see, I'm collecting 40% of the width, meaning I'm only risking 60% of the width. Doesn't matter what Ivy rank is. I'm still able to collect that edge. I actually have a fair amount of edge by going to Moderna. And just to show you that trade here, this is Moderna. Moderna did close at 159.50 here. The July 160, 135 put spread, as you can see, was collecting $9.80, which is just shy of 40% of the width. It'll risk $1,500 in this particular case. And then you can use our P&L simulator that allows you to simulate the potential outcome of each trade next to any other strategy that you want to trade. If you want to compare it to buying a call option, you want to compare it to buying a debit spread, you can check out this strategy side by side with other strategies and see if Moderna stays where it is, how much profit do I have if I bought the call or the debit spread versus the credit spread, and vice versa. If the stock really takes off, how much do I make on the call versus the credit spread? And understanding your risks and rewards are so important before you place that trade. Know exactly what your potential outcomes are. That's how you're going to be able to gain confidence and consistency in your trading. So the credit spread report is something that you can find in OptionsPlay by either going to your education and resources section here at the top, which will take you to the OptionsPlay hub. Within the hub, you will have the credit spread opportunity report, which is right here. Or when you're using the OptionsPlay platform, there is a link here at the bottom of your screen that will take you directly to the credit spreads file, which you again will find once you click on that, it will take you to this link. Like I said, the credit spread file is sorted for you based on premium versus width. So what you're trying to do here is find skew where the option that you're buying is significantly cheaper than the option that you're selling. If you find an option that out of the money option that's relatively inexpensive and an option that you're selling at the money that's relatively expensive, that's how you're going to be able to bring this advantage, if you will, to your trading. And this platform basically does that work for you, scans the market, and only provides you with the symbol, the exact expiration dates and strike prices, and sorts it for you so that you have the highest edge at the top of the page. And then you have IV rank and earnings date to help you make a decision as to which one you might want to trade. But it always takes into account the technical picture here as well. So that, Moderna is always a stock that is recently a bit oversold, which has a higher opportunity of bouncing higher. Those are the opportunities that we see. Let's take a look at General Dynamics now. What we're seeing is that General Dynamics recently pulled back here. That is the opportunity for that to move higher here. And for General Dynamics, for example, we're selling the 190, 177.5 for the July 2nd. So we'll take a look at that July 2nd. 190, 177.5. This will collect $4.55 out of a $12.50 spread. So $4.55 out of $12.50 is 36.4% of the spread. That's how much premium I'm going to collect on this credit spread. So we're trying to find credit spreads that give you an edge, and it does all of that work for you. It finds a directional view, it looks for liquidity, and also finds options trades that give you that edge. So with that, that covers what I wanted to share with you here today. Like I said, to get access to all of this, free 30-day trial available at optionsplay.com/webinar-trial. This is all recorded, and we will make the slides available to you within the YouTube link when we send it to you. So all of our recordings we send to you on YouTube. I highly recommend that you subscribe to us on YouTube after you get the recording. This way you'll get access to all of our educational content going forward. And within the description of the YouTube video, that's where I always post the links to the slides so that you'll have a copy of these slides that you can watch along with the recording. So at this point, what I'll do is I'll open this up for Q&A. There is a Q&A section at the bottom of your screen. So please click on the Q&A section and I'll try to answer as many questions as I have time for here today. There's a lot of questions that I've already answered, like why don't we sell far out of the money credit spreads? I've answered that already. What are your thoughts on selling out of the money puts at 1 standard deviation? I've already answered that here as well. Why not sell weekly spreads? Great question. So we've back tested this. Weekly spreads vastly underperform 45-day spreads. And a lot of it comes down to the fact that weekly spreads, you're going to collect many times you're going to collect far less than 1/3 of the width. And the second reason is because when you trade 7 weeklies, you're adding 7 times the transaction cost. Most investors don't really consider the transaction cost and how much it actually eats away into your strategy. If you had to trade 7 times the transactions, I guarantee you whatever edge you get in terms of theta for selling 1 week options 7 times over, you're going to lose more than that just on transaction cost alone. And when I refer to transaction costs, I don't mean commissions. I'm talking about the spreads between the bid and the ask price. Why best practices to exit a loss at a certain percentage of max gain? I think the point of risk reward looks favorable. You don't have much left to lose. This just comes down to having a mechanical rule, having rules generally speaking, will save you some premium here. Even if you're saving 50 cents or a dollar, that's 50 cents or a dollar that you have pretty much a 90% chance of losing. So why not save that 50 cents or a dollar and put it towards your next trade? That's the reason behind it. You have almost no chance of making your money back on a credit spread that's lost in 80% of its premium. So for those reasons, that's why we have those rules. Save that small amount of premium. It goes to your bottom line in the long run. Does credit spread report take fundamental also? No, it's just based on technical view. If you think IV rank is marginally effective, why is it on the credit spread? So it's good in terms of a tiebreaker, if you will, right? So for example, if let's say I have the difference between these two 35% trades, right? Dell and MGM. They both have 35% of the width. One reports earnings in 9 days, one reports earnings in 72 days. Probably not the best comparison because one has earnings and one doesn't. Let's take a look at the next one, MGM and Lockheed Martin. They both don't report earnings for another 60 or 70 days. They both collect 35% of the width. In that particular case, if I am directionally indifferent between these two strategies, I'll choose the one with slightly higher IV rank as a disqualifier or as a way to kind of break the tie, if you will, between two trades that are relatively similar. But I'm always going to take the one with the highest premium versus width because that means I risk the least amount of capital. Do we enter this trade with the OptionsPlay platform? No, you don't enter the trade with the platform. You enter the trade with your broker's platform. So when you click on the trade button, we'll show you how to enter this trade into your broker's platform. What if I only want to use index funds? So if you want to use index funds, there's nothing wrong with that. Just so, for example, if you use XND, the NASDAQ 100 micro index. The only thing about this is that you're never going to collect anywhere near a third of the width here. So for example, if I sell the 132, 124 here, as you can see, I'm collecting $2.60 on a $8 wide credit spread. So this is actually not bad, $2.60. That's as good as I've seen most of these. Most of these are only going to collect 25% of the width is more common. So you have simplicity with index options. You have tax advantages with index options, but what you lose is the edge, that the skew that you typically have when you're trading single stock. Hello, Tony. Thanks for the well-presented teaching. Smashing. I am new to OptionsPlay and subscriber to daily trades. Today, you suggested the LMT put spread. This trade has still not crossed the sell strike of 390. Can you please comment on your views as to whether this trade will be profitable, please? I'm not sure what you need me to comment on. We just entered this trade here today, so there's not much to comment on the fact that, we're bullish on Lockheed Martin. We sold the put credit spread here on Lockheed Martin, but it's a 45-day trade. 1 day doesn't really mean anything. Don't your exit rules alter your percentage of winners required to break even calculation? It does, Lou, in the long run, but these are percentages that we've already back tested. I use IB and anything with the 50 delta is 2 strikes in the money, not at the money. Why? So Tony, so 50 delta is many times, especially in more volatile stocks, 50 delta is slightly in the money. So you can't really use exact deltas. We always use the first out of the money strike. So the more volatile it is, the more likely a stock may be in the money at expiration. And also you have to account for dividends. So those are the reasons why 50 delta is an approximation for an at the money. But to be more accurate, what we're doing is we're selling the at the money strike price, and then we're buying back a 25 delta. Will the broker assign the short leg without closing the buy leg if the sell leg is in the money at expiration or earlier? So Stan, this is the reason that we have the 21-day rule. We want to avoid assignments we don't want to be assigned on this. So that's why we exit 21 days from expiration. This is another reason not to sell weekly options, because weekly options, you have a very high chance of being assigned early on a credit spread. When you sell a 45-day and you exit 21 days to expiration, no one is going to early exercise an option that's still 3 weeks from expiration, because they're going to lose out on all of that time value. Where do members view or download the report from OptionsPlay? So I think I already showed you that. It's at the bottom of your platform. 21 days rule. How do you determine when to roll or close? So these are the three rules. You will either exit at any of these three rules. If you want to exit them and you want to roll it to a new credit spread, you can, but this is your trigger to actually exit the trade. Once you exit, you can either choose to just completely walk away or you can choose to roll. That's up to you. I have found that a 100% of max loss can happen in a minute. Just a thought. I'm not sure how you would find 100% of max loss can happen in a minute, Ed. Perhaps because the strategies that you were trading were not very liquid and that the spreads widened and they seemed like you lost 100%, but it's almost impossible to lose 100% of the max loss on a credit spread unless you hold it to expiration. Otherwise, it's virtually impossible because you have two legs that are effectively hedged. Does the chart take the bid-ask price into calculation? So our spreadsheet only looks at very liquid symbols. So yes, we look at liquidity in this spreadsheet. And bid-ask spreads are part of our liquidity calculation. Is it possible to be in more than one trade risking 2% at the same time? Is it possible to be in more than one trade risking 2% at the same time? So each trade should not risk more than 2%. You can have multiple trades on, but each trade that you have on should never risk more than 2%. For index options, do you still recommend 33% of the width? Yes, but you're going to find that it's almost impossible to find credit spreads that collect 33% of the width on index options. As far as the 21 days, you don't need to stick to that rule because you don't have the early assignment risk, but you still have the gamma risk. So for those reasons, yes, we still recommend closing at 21 days and rolling it out to another 45 days. Dollar risk rule means total risk per trade or 100% of the profit that we want to exit the trade at. Ray, I'm not sure I understand your question. If you don't mind clarifying. When a stock is oversold, sell bullish put credit spreads. When a stock is overbought, sell bearish call credit spreads. How do we know that we are not going against the trend? Thanks for the seminar. The reality is that you don't, right? That's a risk that you're taking. You never know for sure, right? So you have to find a time frame that you're more comfortable around trading. You know, we use the 21-day moving average. We tend to find that short-term swing trades tend to gravitate around the 21-day moving average. So as a stock kind of moves significantly below the 21-day moving average, it tends to move higher. The one that moves above the 21-day moving average tends to move lower. You know, the 21-day moving average we tend to find is a pretty good mean reversion tool, if you will, for the 45-day credit spread. Would you recommend less than 33% of the width on credit spreads if I'm doing a put credit spread and a call credit spread and an iron condor because I'm bringing that amount twice for the same risk? If your total premium that you're bringing in is more than 33%, but the underlying that's where, you know, Daniel, I don't think you want to apply credit spread rules to iron condors, because if you think about the iron condors, it's really two credit spreads. You still want to stick to the same rules for each leg. Just because you're trading it together doesn't mean that the rules for the separate legs don't apply. So I don't agree you know, on that per se, but I'm also, but you're never going to collect 33% of the width on an iron condor on each side. That's just not going to happen. What you really have to look at is how wide your iron condor is. The wider your iron condor is, the less you're going to collect in terms of premium, but also the higher probability of profit you have. You just have to find the right balance. So it's hard to have one hard and fast rule for iron condors because it's completely dependent on how wide your condor is. How does the scan choose only overpriced options? It's not necessarily choosing just overpriced options. And there's really no such thing as quote unquote overpriced options. There are either expensive, relatively cheap options. And what we're doing is we're trying to sell the relatively expensive ones and buy the relatively inexpensive ones. How do we find that? We find ones that collect more than 33% of the width. That's when we have that skew. To calculate the risks of the trade, so we subtract the premium received from the width of the spread. That is correct, Fernando. Is it wise to ever reduce the spread between the short and long strikes while still selling the at the money short strike? So no. So the question is, if you're selling the Moderna credit spread, let's go back to Moderna. So before we were looking at the July 16th, I think it was the 191 7 1 sorry. It was the 160 140, I think it was something like this. And Donald's question is, does it ever make sense to make it narrower? And some of the times I'll hear people will say they'll make it narrower because they can risk less, right? Because the 140s, as you can see, I'm risking $1,000. But if I make it narrower to 150s, I'm only risking half as much, right? Why wouldn't I trade something that risks half as much? So here's the thing. The reason that you don't want to trade something this narrow is because the deltas between these two options are basically very similar. And what that means is that if Moderna rises, whatever you gain on the 160 put, you're roughly going to lose very similar amounts on the 150 put, which means that if you get a quick rise, you're not going to be able to actually take profit on this trade because whatever you gained on the 160, you've lost on the 150. The only way you make your profits is if you hold it to expiration. So that's why, we don't sell too narrow credit spreads, because if you sell a credit spread where the two strikes are very close to each other, even if the stock moves in your favor, you're not going to see those gains because your net delta is next to zero or very close to zero. You have to rely on theta in order to make money. And that means you can have the move happen, but you don't see the gains. And then as you hold on to it, maybe the stock declines and now you've lost money on the trade. So you got the directional view wrong, but because you've traded such a narrow spread, you now have to get not only the direction and the timing right. That just adds one other element to the trade. Versus if you trade something like a 160, 140, the only thing you really have to get is directional view right. If you get the directional view right and you get the timing right, you'll make money. But you can get the directional view right and the timing wrong, but also make money. If you trade something too narrow and you get the timing wrong, you could end up losing money on the trade. How often is the credit spread list updated? It's updated every single hour. Does your credit spread report mostly cover large cap stocks? It only covers large cap stocks. I'm less interested in unknown stocks or illiquid stocks. So Ronald, we wipe out all illiquid stocks. So as you can see, there's not a single stock on here that you probably don't recognize. We only look at large cap, very liquid stocks. How much is the cost after the 30-day free trial? It is $100 a month or $750 for the year. When discussing when to exit, you stated exit with a loss of 100% of max gain. And this example should it be 4 or 8? The 8 is the debit. The 8 is not the loss, right? So if you sold something for $4 credit and you pay $8 debit to get out, your loss is $4. That's why it says a debit of $8. It's not a loss of $8. It's a debit of $8. How do I keep up with my profits and losses over the long term? Well, I hope that today's session taught you a strategy that allows you to keep your profits and losses for the long run. I haven't been able to get the same fills as you for some of your portfolio trades. Which broker do you use? Claudio, I trade at TD Ameritrade. I can speak to the execution quality at TD Ameritrade. Pretty much anything that's very liquid, I put in my orders at the midpoint. I usually don't have to move them more than a couple of pennies off of the midpoint to get filled. That's how I generally, I have not had many problems with executing at Thinkorswim. Can you close the trade using the stock price as a stop loss and close the spread by buying back, thus reducing the loss further? You can, absolutely. The challenge there is that you can get stopped out and the stock goes back in your favor. So that's why we generally use the options pricing to use our stops, not based on the stock price. But you can if you want to. Where do you see overbought, oversold? So Richard, there's no industry standard of overbought, oversold. You can use, stochastic indicators. You can use a moving average. We like to use a 21-day, exponential moving average as a good starting point. As you can see, when the stock moves substantially above its moving average, those are opportunities to buy and sell. We're looking for deviations away from the 21-day moving average as those opportunities to either buy or sell. How is this different than what's offered at First Trade? So First Trade, you don't have the credit spread report, right? So you don't have the options education sessions. You don't have the credit spread report. You don't have access to our daily trading signals. You don't have access to earning calendar, liquidity reports, straddle reports, unusual volume reports. This is all part of your free 30-day trial or your membership. First Trade just gives you access to the platform. Even if I use 50 delta, how do I get a good fill, especially if bid-ask spreads are wide? If the bid-ask spreads are wide, you probably shouldn't be trading it. That's why our credit spreads are only on things that have very tight bid-ask spreads that are very liquid. Is a 30-day trial a 1-month package or a 6-week package? It is a 30-day package. Can you sell in the opposite direction of the stock move? I'm not sure what do you mean by can you sell? You can sell it anytime you want, right? So if you want to do it when it's in the opposite direction of the stock move, that's completely up to you. How long do you recommend paper trading credit spreads before going live? So Bill, I think that for most investors, trading like a couple of cycles of them is enough. I think you really have to start placing trades with just a single trading lot, one contract. Start trading with live money. The sooner you can do that, the faster you're going to learn. I would stick to small dollar amounts like MGM, as you can see, $39 stock. SLB, $33 stock. Selling one contract, you're risking a couple of $100 at a time. That's the best way to learn after you do a couple of cycles of credit spreads. Paper trades. Can you talk about if you have guidelines for when to and when not to roll credit spreads when things go wrong? Generally speaking, there's never a good time to roll credit spreads when they go wrong. If they go wrong, that means you got the directional view wrong. Get out of the trade, move on to the next trade. Trying to roll credit spreads when you've lost money is just throwing good money after bad money. Just learn to take a loss and move on to the next trade. You're never going to be able to get the markets right every single time. So you're going to be wrong, and you're going to be wrong 40% of the time. Be comfortable with that. That's the reality of trading. The sooner you grasp that, and the sooner you get comfortable with the fact that you can't get the markets right all the time, that's when you're going to succeed as a trader. It's the people who can't seem to let go of a loss, who keep holding on to losses, who keep thinking that I got to win. Those are the traders that I tend to find that blow the big holes in their portfolios when they're emotionally cannot detach themselves from being right, cannot detach themselves from losing money. Those are the traders that lose the most money. And it's sort of ironic, right? Because a lot of times it's in the pursuit of trying to not lose that causes us to blow the biggest holes in our portfolio. But if you look at the most successful traders, they're the ones that manage risk the best. They're the ones that say, I can't be right all the time. I know I'm going to be wrong a certain number of times. When I'm wrong, I let go of it. I know I knew how much I was going to risk. I was wrong on the trade. I lost that amount. I move on to the next trade. It's the traders that can't let go of that loss and say, no, I don't want to lose that. I'm going to risk a little bit more to try to get myself back to break even, that start digging themselves into bigger and bigger holes. And it may not happen the first time, may not happen the second time. And you might have plenty of adjustments that work out for you that turn that small loss back into that small win. But it always takes that one adjustment trade that just keeps going loser after loser. And if any of you have experienced that, type yes into the chat window where you just said to yourself, I don't want to be wrong. Let me buy a little bit more, hoping that it's going to come back, but only for that stock to continue moving in the opposite direction. And next thing you know, you intended on losing $1,000, but you've actually lost $5,000 on that trade. And it's because you couldn't just let go of being wrong and let go of that $1,000 loss. Many times that starts because you traded too large on that first trade to begin with. Emotionally, when we trade too large, we feel attached to that trade and we can't just let go of a large loser. But if you start small, you trade small, those smaller trades are easy to let go of, right? If you risk 2% of your account and you're wrong, it's easy to let go of that. But if you went too large to begin with and you risk 10% of your account and the trade goes south, you're emotionally invested. You're what poker players call pot committed. You can't let go of that, right? You say, if I lost this trade, I'm gonna feel terrible because I've risked too much. I can't do that. So what you do is you do everything you possibly can to bring this 10% trade back to break even. And sometimes that works, many times it doesn't. And that 10% risk turns into a 20% risk, 30% risk. Sometimes I've seen traders blow out their entire accounts going after that strategy. So I understand the desire to try to turn losers into winners, but it's usually in the pursuit of that causes most traders to really blow up their accounts. So on that note, I've tried to answer as many questions as I have time for here today. I unfortunately couldn't get to all of your questions, but I do encourage many of you, when you're watching the recording, type your questions into the comment section on YouTube. And remember, if you're a first-time user here of OptionsPlay, and it seems like many of you are, sign up for a free trial, completely free access to everything. I do Tuesday morning sessions where I teach you, where I talk about the markets. We did one this morning, talked about where the current markets are and what my views are. We send out daily trading signals. Many of them are credit spreads. About 80% of the signals that we send out are credit spreads. Those are handpicked by me and my team. We use the credit spread report many times to find those opportunities. Every single Thursday, I do an options education session to teach you about option strategies similar to this. And you get access to the OptionsPlay platform, the credit spread report, and all the other reports that I showed you. So whether you sell cover calls, you sell straddles, you look for unusual volume, those are all part of your free trial. So I hope that you guys have found this useful. If you're already a free member or a free trial or a member, I hope that you found this useful in giving you a better understanding of these strategies and how to use our tools. And if you've never used this before, hopefully you sign up for that free 30-day trial and check us out. So with that, thank you so much. We'll send out the recording to you guys as soon as we finish here today, and have a great afternoon. And I'll see you guys here on our next session this Thursday, which we're going to be talking about trading interest rates. Very, very special session, trading interest rates using small futures. I've been learning a lot about that. I want to share with you many of the things that I've learned about trading short-term interest rates, long-term interest rates, scalping strategies, long-term strategies. We have a professional interest rate trader to talk to about those strategies. Really looking forward to that session. I hope many of you do here as well. Thank you so much and have a great evening.